If you look at the American stock market right now, the story seems pretty straightforward. Trillions of dollars are flowing into tech and AI, creating a facade of an economy that looks invincible on the surface. But the momentum driving those record highs is being fueled by forces far beyond domestic corporate earnings or excitement over new software. There is a massive, quiet dependency on the Japanese yen, which has steadily collapsed to a 40-year low against the US dollar. That decline has reached a breaking point. Japan's finance minister has now called for the nation's massive pension funds to shift their investments back into domestic assets, signaling a potential repatriation of roughly $900 billion currently sitting in U.S. markets. If Japan pulls this capital back home, it would remove a major source of the global liquidity that has underpinned the value of American equity markets and retirement accounts for years. To understand how a currency crisis in Tokyo directly threatens Wall Street, you have to look at a financial engine known as the carry trade. The mechanism is simple. Institutional investors borrow massive amounts of Japanese yen because Japan's central bank has kept interest rates near zero, making it the cheapest currency in the world to borrow. Those investors then immediately sell the yen and convert it into dollars to buy higher-yielding assets, ranging from U.S. tech stocks to government treasury bonds. This remains a winning strategy as long as the yen continues to weaken. The lower the yen falls, the less it costs the investor to eventually repay that original loan, allowing them to pocket the exchange rate difference as pure profit. Because this trade has persisted for so long, the current valuations of many U.S. stocks have become closely linked to the continued availability of this cheap, borrowed liquidity from Japan. This creates a dangerous inverse relationship. When the yen gains strength, American equities often face intense selling pressure. This chart shows the Japanese yen spot rate against the Nasdaq 100. Over the last few years, the pattern is consistent. Whenever the yen starts rallying against the dollar, the tech-heavy Nasdaq enters a sharp decline. This happens because a rising yen forces global investors to unwind their trades. They have to sell off their U.S. stocks to repay those Japanese loans before the shifting exchange rate turns their profit into a loss. Japan is now being forced to trigger this reversal because inflation at home is running hot for the first time in decades. Stagnant wages and rising costs are putting immense pressure on Japanese households, while the bankruptcy rate for mid-sized businesses is climbing at a rapid pace. To stabilize their own economy, Japanese policymakers must force the yen to strengthen. This means they are incentivized to pull liquidity out of the U.S., even if it causes a significant disruption across American markets. This looming capital flight is particularly dangerous because the internal structure of the American market is already highly unstable. This is the VIX, which tracks market volatility. Currently, it is resting at one of its lowest levels in 5 years, creating a deceptively calm environment for investors. However, an indicator called single stock volatility is currently at a 2-year high. While the broad indices look stable, individual stocks are swinging wildly, suggesting that the broader market is primed for a sudden, sharp break. This underlying fragility suggests that a large-scale repatriation of Japanese capital could trigger a volatility event far more disruptive than a typical market correction. The primary vehicle for this repatriation is Japan's Government Pension Investment Fund, or GPIF, which manages a staggering $1.8 trillion in assets. But an immediate sell-off faces a major hurdle. The GPIF operates on a rigid 5-year framework. Since their latest review was just completed in 2025, the fund's managers may resist political calls to overhaul their portfolio before the next scheduled review in 2030. While red tape may delay a state-mandated move, the mere threat of government intervention is often enough to spook private investors into dumping their U.S. holdings before the official institutions begin their exit. For American investors, the macro landscape is shifting. The years of a weak yen acting as a quiet, reliable support for U.S. tech stocks appear to be ending. Navigating this volatility requires a shift in defensive strategy. During past periods of extreme market stress, intermediate and long-term U.S. safety, often providing a hedge against equity downturns. To protect a portfolio in this environment, it is no longer enough to watch earnings reports on Wall Street. You have to monitor the monetary policy signals coming out of Tokyo.